The thesis is titled Three Essays on Corporate Finance. Corporate finance theories are usually developed assuming perfect financial markets. However, in reality, the real world environments are characterized by imperfect markets. Given this thesis on corporate finance looks at important corporate financial decision making in the presence of information asymmetries, heterogeneity in institutional structures, and regulatory interventions. Falling under the broader domain of corporate finance, I have three independent essays that looks at three different important financial decisions. The first essay looks at intercorporate financing, the second essay looks at delisting decisions, and the third essay looks at cash holding decisions. Using these three essays, this thesis pursues three research objectives, which I'll be discussing in subsequent slides. The first essay is titled, Does Related Party Regulation Curb Zombie Evergreening? Evidence from Indian Private Firms. It pursues the first research objective, that is to analyze how regulatory interventions influence the financing and investment decisions of firms reliant on intercorporate lending. In this essay, I examine zombie firms, which are economically unviable firms that survive on subsidized credit from banks and other creditors. I examine whether other corporate entities support these zombie firms through lending. Particularly, this analysis is carried out in the shadowed world of unlisted Indian firms because of the limited public scrutiny which they are subjected to. Given this limited public scrutiny in the unlisted Indian firms, I intend to examine that if there is a regulation that restricts the support that is being extended to zombie firms, then what is its impact on the investment and financing decisions of the zombie firms? I find that zombie firms are indeed supported by other entities through intercorporate lending, and this regulation that restricts this implicit support actually has a significant impact on its investment as the investment declined substantially after the regulation. And given the financing decisions, the zombie firms are observed to have been being unable to source credit from other sources of borrowing because the lenders have now become more cautious given the absence of implicit support. I also look at the value implications of this regulation and find that the regulation has had a disciplining effect and has reduced such inefficient transfers. This essay contributes in the following ways. First, it provides direct evidence on the role of corporate entities in sustaining zombies through intercorporate lending. It provides and establishes that firms' connections may transcend beyond group boundaries. It provides a novel causal evidence on the impact of exogenous shock on financing and investment patterns of zombie firms, and also provides positive valuation implications reflecting improved governance, hence providing insights to policymakers that regulation, if implemented properly, can strengthen financial discipline. The second essay is titled A Short Stay in the Spotlight, R&D, Corporate Transparency, and Global P2P2P Transactions. This essay pursues the research objective 2, which is to examine how cross-country variation in reporting quality influences the early going private decision of firms. In this essay, I examine what are the determinants of firms going private from the publicly listed markets, and I find that innovation is a crucial determinant. So I find that innovative firms are subject to short-term market expectations, losing confidentiality and risk of higher proprietary cost, which is why they prefer going to public markets. I find that the downsides of equity markets are particularly heavy for innovation intensive firms than the financing benefits that they derive from these markets. I also find that corporate transparency plays a moderating role wherein a country level information environment impacts the chances of going private of innovative firms. In transparent environments, firms actually benefit a lot from the financing and non-financing benefits. Therefore, the proprietary costs are not that big an issue for them to return to the private markets. This study has following contribution. First, it provides evidence on largely overlooked determinant, that is the innovation in going private, highlighting the crucial role of innovation in early delisting of IPO firms. It shows risk of proprietary cost can outweigh the benefits of remaining publicly financed. It advanced the corporate disclosure literature by highlighting information efficiency role of disclosure. It shows the role of country level information environment in moderating the relationship of public-private choices, and it offers policymakers valuable insights that disclosure regimes can act as effective policy tools to anchor innovative firms in public markets. The third essay is titled When Oversight Overreaches, Business Groups, Cash Holding and Related Party Reform Paradox. The research objective it pursues is that to investigate how regulatory reforms alter cash holding policies of firms when they serve as providers of financial support within internal capital markets. So, in this essay, we look at emerging economies which are characterized by underdeveloped markets, wherein firms organize themselves into groups which form internal capital markets of their own, where they share resource as well as risk. There are certain benefits of internal capital markets which are only provided to the business groups or business group members that are part of that ICM and not to the standalone firm. Therefore, we investigate the cash holding of business group versus standalone firm because cash holding is an essential catalyst for resource as well as risk sharing in the ICM. We particularly look at a regulation that restricts the fund flow within the ICM and find that when the flow of funds is restricted, whether it has an impact on the cash holding motive of BG and standalone firms. I find that business groups have reduced their cash holding significantly after this regulation. Further, I also look at the group heterogeneity because heterogeneous firms within the groups may have different motives of holding cash. Therefore, I find that providers within the group hold higher levels of cash and have reduced it significantly after the regulation. We also look at the mechanism, which is the intercorporate lending, and we see that it has reduced significantly after the regulation. I also look at the value analysis, and I find that value analysis rules out the expropriation narrative of holding cash. This thesis contributes in following ways. It shows the direct effect of ICM on corporate cash holding, demonstrating direct impact of nuanced heterogeneity within the groups. It establishes that listed affiliates have legitimate reasons to maintain higher cash levels against conventional view. It also looks at value of cash analysis and rules out the expropriation narrative and provides insights to the policymakers of practicing prudence when regulating ICM, as there are inherent complexities within them that make it challenging to differentiate between efficient transfers and those driven by expropriation. Therefore, I thank my research advisory committee for carrying out this work because there have been their valuable feedback and consistent support from them. I thank my research advisory committee chairperson, Professor Jijo Lucas, my area member, Professor Nimira Jediapa, and my cross-area member, Professor Ashok Thomas. I also thank my thesis evaluation committee, chaired by Professor Kumar, and the external members in the committee. Their valuable feedback and constructive comments have helped enhance the quality of my work. Thank you.